Over 50% of our investors reinvest their distributions every quarter. And that's not surprising. We do a lot of educational work with our investors. We want to make sure they understand where their money is, what we're doing with it, and why I'm making the decisions I'm making. And the more they learn, the greater confidence they have.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McCleard. Let's go, baby. All right. Welcome back. I'm your host, Randall McCleard. Let's get started. Today, I'm joined with Pat Poling. He's a founder and CEO of Mara Poling. They are an investment company out of California. They do a lot of work here in Texas. They have a fund, so we're going to dive into funds and their fund structure. He has a wealth of knowledge and has been in real estate for many, many years. So I'm really excited to have him on the show so that he can share that knowledge with you and help you down your path to start investing in some deals. So without further ado, let's bring him on, Mr. Patrick Poling. Pat, welcome to the show. It's great to have you on. Thanks so much for making time, and excited to have you share some of your background and kind of your education with the listeners today. So thanks for jumping on. Very curious. I know some of your history. I know some of the background, that the evolution of your company, right? Just from knowing you and talking to you. But if you could explain maybe to the listeners, where you are right now in the real estate space and like how you guys got to this and maybe what your company evolved from over the last 2 years. Because I think that'll give some background, I guess, on Mara Poling.
Great. Absolutely. And thanks for inviting us to be here. So Mara Poling, and I'm the Poling in Mara Poling. My long-term business partner, Bill, is Bill Mara. That's the origin of that. We're a firm focused on providing boutique services to a couple hundred families in the multifamily space. Our focus is to take the 4 decades of experience I've got, plus the experience of all the rest of our team, and bring that to people that don't necessarily have that at their fingertip. Folks that are bright, intelligent, capable, successful, but they're not real estate people. My technical training is in finance. I'm an accountant. I've spent 40 plus years in the real estate game, the last 20 years as an entrepreneur running my own investment firms. And the folks that we work with just don't have access to that kind of talent. And the way we go about doing it's very different than almost any other sponsor I'm aware of out there. And that's because I'm at the tail end of my career. This is not my stepping stone to another bigger opportunity. This is a place for me to give back from all that I've learned over the decades. We started Mara Poling about 10 years ago as we were completing the sale of $16 billion portfolio we had built in the industrial space. And at the time, Bill and I talked about, well, what do we want to do? We really liked multifamily. We had some personal money in it. And we thought this would be a great place to work with families. And that's what we do. So we have a retail fund that has about 150, 160 families in it with modest investments of $25,000 or $50,000 upwards of $1 million. And then we have a family office operation where we work with another roughly dozen families doing much more tailored work for them. And that's all in the million, $5 million, $10 million, $15 million range in terms of that. But it's really important to us that we aren't any bigger than we are now. There's a few more families coming on board. And that's because it's a requirement for me that I have a personal relationship with each and every client. When they pick up the phone, there's no 800 number they're calling. They call me directly. We just sent out quarterly statements yesterday. I got a handful of emails from folks last night. I sat at my desk and answered those last evening. It's important to us that people have that kind of connection to the person that's making the decision about what's going on with their money, because we're stewards of some really important things. People have worked hard for those dollars. To a person, they are all in the mindset of, I don't have time to go make this money again. I have to protect this capital, and I want it to grow, and I want it to do well. But job one, I can't lose any of this money. And that's very much the focus we have.
Yes, I can attest to that because that's how I reached out to you. I know that you do answer your emails. I listened to something you were on, I can't remember, and I wrote you an email directly and you responded pretty quickly. So yes, you are available and I appreciate that. I guess getting back to when I met you a couple years ago, maybe a year ago, 2 years now. So you guys have grown since then, right? So how's the team shifted? We can dive into that a little bit, I guess. I don't know if you want to
Sure.
talk about that, but it just seems like you guys have grown and you're buying in Texas. And so, yeah, give me some.
Absolutely. When Bill and I first started, it was just Bill and I. That was kind of the idea was, all right, we'll go do this. And I raised money and managed investors and, the overall direction. And Bill basically did all the work. And over time, other folks joined the team. Lauren Torres. Lauren's now our chief operating officer. John Jones. John's now our chief investment officer. Accountants and operations staff and acquisition people and underwriters. And all of that's come as we've been blessed with more clients coming to us. In particular, in the last couple of years, it's been this family office kind of business where we've had clients come to us with, I'm selling $12 million of real estate. I don't have, my basis is down to zero. I'm getting a $12 million check. I don't want to pay that kind of tax. What can you do for me? And we'll go out and buy a $25 or $30 million property and get that person into it and then manage it for them over the long period of time. And it's quite something how many folks have very successful real estate portfolios and themselves are actually not very adept at real estate, right? It's been a byproduct of something else that they've done. Maybe they're an entrepreneur and they've simply owned the buildings that their business was in. And when they sold their business, they had these buildings and now they're trying to figure out what to do with it next. And so the custom tailoring of that, which is essentially the work that we do, because it's not an off-the-shelf kind of investment opportunity, takes an enormous amount of work. That's really been where the growth of the team has come. The other piece of that is Bill retired a little over a year ago. I'm not going anywhere soon, but I'm going to retire someday. Our clients have 20 and 30-year investment horizons. I hope to still be here in 30 years, but I'm not going to be working like I'm working today.
On a beach somewhere. Yeah.
Yeah, exactly. And, and hopefully still chatting with clients about how wonderful everything's working. But we've worked hard over the last couple of years to really design the team in such a way that we're structured that we can do that multi-generational work. As you know, we've had this conversation before. Real estate, and we think multifamily is a great place to focus on this. Real estate is one of the few places in the country where regular people, regular Joe Main Street investors, can truly generate wealth for themselves and multi-generational wealth for their family. And it's just pretty simple, one foot in front of the other kind of stuff and being patient and letting time take care of it. And if you do that, you can turn $100,000 into a few $1 million. You can take $1 million and make it $20 million. You can take $10 million and make it $100 million. And if you do it the right way, the government's going to help you out because they're going to say you can pay us the tax later. And maybe you do pay the tax later. Maybe some other events occur that allow that to actually be minimized or maybe even avoided completely. That's what we're able to help people do, is build that kind of wealth out of the success they've already had. Because as I said, these are successful folks. Most of our investors are probably in the medical world. I'd say maybe 80% or something like that. I'm no brain surgeon. We have brain surgeons that invest with us because they're not finance people, right? Yeah. They took their talents and learned how to keep the rest of us healthy and alive. And I learned how to manage numbers. Yeah. And together we can create a really good team.
Yeah. Interesting setup. I guess the tailoring part, it's like a bespoke sort of finance sort of product that you've come up with in order to, because it must be challenging to have a family office or a small family office. And maybe they're not even organized as a family office or call themselves that. And then they say, we want this, and this. We want income. We don't care about this or that, but make sure you optimize on this side. And so then you have to go find an asset that actually works for that or structure a deal that works for that. So that's a really interesting model that you've got. And then you were talking about something else. So you were talking about your investors. Yeah. So on that front, this environment that we're currently in, the current market that we're in, and you buy in Texas. I don't know other markets if you're expanding in other markets, but from what I know of you, you guys are buying in Texas. So what, if anything, are your investors telling you now? Is there any concern? Is there business plans for Maripolling this year? Are you guys acquiring, trying to dispose of things? What's it looking like?
Investors are wonderful people, but they're humans, right? And ultimately, they're consumers like any other consumer that's out there. And I've always loved focus groups and ways to get feedback. And those are interesting points. But customers really talk with their wallets, right? It's where people put their money that tells you what's really important to them. Over 50% of our investors reinvest their distributions every quarter. They're buying more into multifamily. About a third of our investors have either opened new accounts or added substantially to their existing accounts since they first opened them. And that's not surprising. Again, the investors we're working with are folks that have an interest in real estate, don't necessarily have all of the capabilities or understanding. And part of the value proposition in working with us is we're going to teach you. We do a lot of communication, a lot of educational work with our investors. We want to make sure they understand where their money is and what we're doing with it and why I'm making the decisions I'm making. And the more they learn, as demonstrated by the numbers I just shared, the greater confidence they have. Our strategy in particular, and it's the reason we're in Texas, you're right, we like Texas. We don't like Texas because we're a bunch of Texans, although we have a lot of Texans on the team.
Hey, now.
We're in Texas because the data says be in Texas. You know, when we do our annual assessment of the markets in the country that meet the criteria we have, about half of those markets that qualify are in Texas. And that's why we're here. If suddenly that changed and we saw that, you know, Georgia or Florida or the Carolinas or some other market was really going to be more dominant, then we would start adding properties in those markets because it's all about managing risk and planning for the long term. I'll give you a great example. I've got an asset. You asked what we have going on. We're taking this asset to market right now, which every year we're buyers and sellers. There is no such thing as a real estate cycle for long-term real estate investors. It's the ultimate in dollar cost averaging. You're constantly doing work in the market, and sometimes you're going to be getting a higher value, and sometimes you're maybe not going to be getting as much. And also, by the way, if you're not getting as much, you're paying a little less for that asset you're rolling into. So over a long period of time, there's a lot of value that comes from that. We get an asset we're going to market on. I bought the original property with about $2 million in cash and then debt. That I walked away from with $3 million, put a few more bucks with it, and I bought a $10 million property. That $10 million property is now a $15 million property. I've turned the original $2 million into $7 million. I haven't paid any tax yet, and I've done that in about 5.5 years. The result is this next asset that money rolls into, while it will generate that 7 to 8% cash return and roughly 10% equity growth on an annual basis on the $7 million that goes into it, when you lay that over the $2 million in original investment, plus the extra few dollars we've thrown in, we're going to be seeing cash returns in the 16 to 17% range and equity growth that's in the 20s for a total return that's going to be nudging 40%. Well, how on earth do you make 40% investing conservatively? Time, right? It's all about letting the properties do the work. When you build up enough lazy equity in them and you've taken that nice tax advantage, you can roll out of it, move into a new property. And that's right now, that's probably half of the work we do is managing and cultivating the existing portfolio, turning those assets. Maybe it's a 1031. Last year, I did a refinance on a property. You might scratch your head and go, with rates where they were, you refinanced? Yeah, because I had $4 million sitting in an asset that wasn't doing anything. Yeah. And I'm getting a substantial incremental return, even though I'm paying more for that money than I'd like to. But that $4 million is now working. Yeah. And over time, that just continues to grow value, but allows me to be really conservative about the kind of properties that we're going to invest in.
We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. Yeah, I've heard you talk lazy equity in the past. That's why you refinance, pull it out, put it to work. So you said something about your fund in there, and I want to dive into that because I'm wrapping up a series. I've been talking about fund managers, their roles, their jobs, what they do. And then I have a call on with a securities attorney. He's going to be coming out, his interview in a minute. And so, yeah, if you can like talk to your fund and how it's structured, because I think the way you've structured it is very unique and interesting because it's like an income fund slash, not. It's you can evergreen, you can reinvest. So just how you structured it and the numbers that you just threw out were phenomenal because of the initial $2 million investment. And then you build that over time. But if people are pulling money out and you close your fund out, then it doesn't necessarily work the way I wouldn't think it would work the same way you've structured it. So I think it's important that maybe you can speak to that and explain that a little bit better than just the high level.
Absolutely. And I think the way to understand it is to go back to before we had our fund. So we did individual syndications, the first handful of properties that we did.
Yeah.
Pretty much the traditional model every sponsor has, right? You go out, you raise a bunch of money day one, we go buy a piece of property, people get checks along the way. If somebody wants to put more money in, no, thank you. I already raised the money I needed on day one. If somebody wants to leave, it's like, I don't have a mechanism for that. You're kind of stuck. And when we get to the end of the deal, we cash out, you get a K1, you pay your tax, and we all move on to whatever it is we're going to go do next. Selfishly, I didn't like that because I hate raising money. It's not a fun process, right?
Yeah.
I love working with clients and helping solve problems for them, but I'm an accountant. I'm not a marketing guy. That's not where I want to spend my time and energy. And so the notion of running around every single time we buy a property and having to find money was not something I looked forward to. So we said, what if we came up with a way that people could contribute and they could invest at any time they wanted? If we met somebody and they said, this sounds like a good deal, I want to get in, they could write a check that day. And let's deal with these issues that individual syndications have, which are, they're not liquid, right? It's hard for me to get out. So let's put a way in that after a certain period of time, people can access some of the equity they've built or even redeem all of their units if that's something they wanted. So for that person, it could function more like an individual syndication over a period of time. But for those that really wanted to build a longer term portfolio and didn't want to do it by going and buying a bunch of individual syndications themselves, they could stay and they could reinvest those distributions, right? So if they get a check, they could say, keep the check, buy me more units in the fund. They get a tax refund. They could call me and say, hey, I've got 20 grand that just showed up. I want to add it. And they could add to their account. And so it really becomes a vehicle for people to manage a real estate portfolio for themselves, and you get the diversification of multiple assets and all the rest of that. Our fund today has 7 different properties, either owns outright or has positions in. That's going to grow, probably by a few more over time. The fund is structured to run 30 years. I have no idea how long it's going to run. At some point in time, a critical mass of existing members will say, this has been a great ride. We're ready to leave. And then we'll announce the dissolution and start the process of unwinding. But that's not something I necessarily control. Again, people vote with their pocketbooks. And right now, the sentiment amongst the overwhelming majority of our members is, this has been a good ride. We want to keep going. Is that 5 more years, 10 more years, 20 more years? I don't know. We're certainly positioned to be able to do that over time. And most of our assets are second generation assets, meaning they've gone through 1031 already. There's a few that haven't, but most are, which means in the next 3 or 4 years, those will start becoming third generation assets. And when you get to that point, the returns can start getting kind of silly, really dramatic returns on those original dollars that were invested. And for those of you that are listening that are mathematicians and understand IRR, you know that those simple returns, they're not misleading, but they're simple returns. If you look at the basic IRR, you'll see that these assets just continue to chug away at that 13, 14, 15% rate, which, if you're sleeping well at night, not worried about where your money is, you've got access to it when you need to. If you want cash, you could be getting cash. If you don't need income, you can let it compound. And you're getting 13 or 14 or 15% and not paying a lot of tax, maybe none in some periods. That's pretty attractive.
Yeah.
And it's the folks that's attractive to that we seek out. We're not short-term investors. We're not swing for the fences kind of guys. I actually don't really spend a lot of time focused on what the returns are. We buy quality assets. We focus on just managing them well. And if you do that, the rest of it kind of takes care of itself.
Yeah, I want to ask you about the 1031s. So are you able to 1031 within the fund?
We are. So
Okay.
the fund will sell an asset. Last year, we sold a property, $18 million purchase. We exited at $26 million, doubled our money in 19 months. Just crazy. Absolutely not going to happen again. Nobody should expect that.
Yeah.
But when it does, when you've got that kind of lazy equity in there, you've got to make some decisions. And so, for example, one of the things we do that I think is fairly unique in the industry is everybody's got underwrite for how you acquire a property. Well, we underwrite every property every year, and we have an exit underwrite. And the exit underwrite looks at half a dozen different potential strategies to take the value we've generated and put it to work, including just holding the same asset, right? But looking at it from the standpoint of if I could sell it for more money, if I paid 10 and I could sell it for 12, not selling is like buying it for 12. So I need to look at it from that standpoint. This asset was a great asset. We cashed out along with the other investors. So our fund was an investor and we had some other investors in this transaction. We rolled into a brand new asset, fully protected all of that cash. That property had been cash flowing about 8%. We're seeing essentially about a 13 to 14% cash flow right now. And that's because we're still in the early phase of that hold period. The pro forma for that is about a 17% cash on cash return because we basically doubled our money. And the asset we replaced it with is as boring and plain vanilla as, you can possibly get. It doesn't look any different than anything else we've done. And someday that tax will get paid, right? I mean, that's the whole thing. 1031 is not tax avoidance, it's tax deferral, with one exception that hopefully doesn't happen to anybody in the near term. But it's the fact that, for example, on that, somebody puts $1 million in and they make $1 million. Well, on that $1 million that they made, they'd have to pay anywhere from 20 to maybe 50% of that in tax. Well, let's say it's 30%. That's $300,000 that isn't paid. So that $300,000 goes into the next deal. It's generating cash flow. It's growing in value. And eventually you do pay the $300,000. And we actually pay more because the asset's grown in value more. So the government makes out on the deal. They actually get a bigger check because they were willing to wait, not to mention the fact that they incented investment in real estate, which is good for the economy and good for the country. That's, one of the reasons the tax code reads the way that it does. And that's really the power of the 1031.
Yeah.
It's also where our family office business really developed from, because our fund will end someday and our investors will pay tax. Maybe it's 30 years from now, maybe it's 20. For people that don't want to do that want to be able to run 1031s in perpetuity and potentially experience that step up in basis as part of an estate, we do this family office work where somebody might put $5 million in and they'll 1031 that and 1031 it to the point where they have maybe zero basis and this huge gain and a big tax check they'd have to write, but it's 10, 15, 20 years from now.
Yeah.
It's future dollars. And they've had an interest-free loan from the federal government for 20 years. That's a pretty good deal.
Yeah, a lot that you just said there. First thing I want to go back to is I hear a lot right now from other investors in my market and around in other markets. So hard to find a deal. So how are people transacting? Why are deals still closing? And what you just explained is one reason why 1031 money keeps winning deals, though, because the returns on that money, the step up that you're getting, I mean, you're still getting an outsized return on the initial dollars invested. So that's one way, anybody listening to that part of it. On the other side of it, on the fund, I mean, I love that you can come in and out of the deal and just the way you guys have structured that to be able to reinvest. So that's something that, I want to talk to you about separately, but it is something that I would love to get your PPM if you'd be willing to share it again so that I can take a look at it and be like, okay, how can I structure this thing like Pat did?
The only piece of it that's challenging is essentially it's the accounting, right? Because you continually have a shifting basis, right? So people have to kind of track their own basis. But, there's a shifting amount of ownership because people earn a preferred return. For example, somebody has $100,000 invested with us as of January 1st. Well, I just paid a distribution. I just gave them $2,000. If they reinvested, they now have 102,000. So they don't earn a $2,000 preferred return for this quarter. They earn more than that because they had more than 100,000, but it was only for part of the quarter. So for 31 days, they earned, at a 2% rate on 100,000. Then they earned 2% on $102,000. You've got to have a pretty robust machine that can do all of that work. And the same with withdrawals, right? So, you'll have somebody that'll do a reinvestment. They'll add some money to their account. It might be at a certain level where I make an equity award. There are clients that are in that realm. At $500,000 and $1 million, I contribute money in addition to what they put in. So there can be a lot of movement going on inside all of that. And they might reinvest one quarter, and the next quarter they might say, I'm done. And we're getting close to, maybe later this year, early next year, we're going to get to the return of capital phase of the waterfall, where our distributions will include giving back some of the original money, which means their capital account balances draw down. People can elect not to receive those, right? They can say, I want that reinvested. So if you're going to give me $1,000 back, let me give it right back to you and buy back in at that amount. Other people may say, great, this works fine for me, and I'd like to do that. The whole idea is to give people as many options as possible, because that incents people to then say, this continues to meet my needs, so I can stay. The only challenge in managing a fund is being able to make the decisions long term, not having great certainty as to just how much capital I've got to work with. So at some point in time, as I said, we'll start getting enough indications from people that the end is coming. And then we won't be doing 1031s. We'll be just harvesting equity. We'll either be selling or refinancing and pulling out cash as we start to get near the end.
Yeah.
I'd love to think that that's something that, Lauren and John and the rest of the team are going to deal with, that'll happen well after I've retired. But, our job is to be in service to these families. It's up to them to decide how it's really going to work best for them.
Yeah. So let's talk, I guess, the mechanics on the limited partner investor side then. So you've got, let's say you close shop tomorrow, fund is closed, everybody gets their money back, and they recognize this like tax bill, right, as you put it. So are they able to then reinvest those dollars into some form of real estate and they can 1031 it on their own, or that's it? The party's over. They got to pay that tax bill at that time.
Yeah. So unfortunately, the way funds are structured, and maybe somebody else has come up with a different interpretation, but this certainly would be our understanding. Because funds I'm a member in a limited partnership in an LLC that is itself a member in an LLC that's actually on title. So the fund itself is not on title anywhere. So there's not really an ability to do a drop and swap you might do out of a more traditional individual syndication. So no, you can't 1031 out. So you lose that ability to do the perpetual 1031s. You're still benefiting from an enormous amount of gain from getting this, again, interest-free loan from the government that we haven't had to pay on these gains I described before on this one asset that we're up to the third generation. We would have had to have distributed well over $1 million to our investors so that they could pay the tax bills that would have come from all of that gain. We didn't have to. So that million's been invested and helped us continue to grow. And that will continue to happen. Someday it'll get paid. But, if we pay that, if it's $1 million, well, $1 million 20 years from now is like $500,000 today. And that's just at a 3% inflation rate, which, knock on wood, hopefully we get back to.
Yeah.
So, you're paying with future dollars that are less impactful. And I get the free use of that money during that entire time frame. And because by definition with a 1031, you're rolling up into a larger asset, I'm getting some incremental depreciation so I can begin losing money again. That's kind of the beauty of the model is you buy an asset, you write it down appropriately, grow it through value add. You get to a point where there's a meaningful amount of lazy equity in it. Generally, that's around year 4 or year 5. That's also about the time that you've burned through the losses from the very beginning, and maybe you're going to start seeing some tax exposure. So you flip it via 1031 and you start the machine again. And you continue to do that. And I would never tell anybody they're going to have zero tax exposure, but you can have a pretty modest amount of tax exposure over a very long period of time. and convert much of the ordinary income exposure into gain, which gets taxed differently. At least, those are the rules today, and get to use those dollars while we're going. That allows us to invest in pretty mundane, boring assets and pay fair prices for them. And it allows us to be investors throughout the entirety of the economic cycle and the real estate cycle. You asked earlier what investors are concerned about. Well, one of the things I certainly get questions about are interest rates. What's the impact interest rates are having? Well, they've certainly had an impact, right? There's fewer deals available in the marketplace. There's fewer sellers right now. There's fewer buyers, but there's still good deals out there. I love to remind folks that when the country was building, so new development, use that as the metric, was building 700,000 new units a year. So more than twice the number that we're currently building. And think of that. That's over 700,000 on an existing base that was less than half the size it is now. So we're talking about an actual growth rate 4 times what we're doing today. We had double-digit interest rates. So interest rates ultimately aren't really important. It's underwrites, right? If a deal underwrites and the math works, because there's a lot of other factors besides interest rates that make a deal a good deal or a bad deal. It's all math. You plug it all in, and ultimately it'll say, this is how much that property's worth. And if you can come to an agreement at that number, it's a good deal, and you go forward. If you can't, then you leave it for somebody else and you move on. That's one of the reasons we like Texas, is there's enough opportunity here that for a very small company like us, we're going to buy 4 properties this year. That's all we're trying to do. There's absolutely 4 good deals out there amongst all the different opportunities that exist. If I was trying to deploy $500 million a year and I had to buy dozens and dozens of properties, I'd have to be looking elsewhere besides just Texas in order to find the opportunities that could fit in the funnel on one end to get the 1 or 2 deals I need coming out the other.
Yeah, for sure. And you guys, are you still focused mainly like secondary markets? Are you guys venturing into Dallas and doing any San Antonio?
The major metros have become less expensive. We've seen more cap rate movement there than we have in the secondary markets. So there are opportunities there that we've taken serious looks at. It's important for us when we buy an asset that we begin with the end in mind. So a big part of our underwriting is, what's the exit strategy? What's it going to look like in 5 years? And so we really like buying in markets that are not only solid, stable markets with some growth today, but they're going to look like that in 5 years. And so some of the quote unquote hot markets in the metropolitan areas, DFW is a good example. There's a number of markets that are like, wow, everybody in the world's trying to get there. It's like, all right, what's going to happen in 5 years? That's going to be a mature market. The development's going to be done, and people are basically just swapping with each other. There's not going to be new employment because all that's happening now.
Yeah.
So we really like buying on the periphery and the path of growth. Waxahachie, great example, right? Nobody is thinking, wow, there's the place you ought to go put a whole bunch of money. But you go look at that market.
I like that market. Yeah.
Look at the growth that's going on there today. And Dallas is aimed right at it, right? All you got to do is drive 35 and you're like, you know what? It doesn't take that long to get from one part of civilization to the next anymore. In 5 years, will they touch? They don't need to. It still needs to be growing in 5 years so that the person I sell it to can be just as excited as I am. If it's a mature market, it doesn't mean I won't be able to exit. It's just I'll have fewer buyers because there's fewer people that are interested in stabilized momentum kind of deals than value add growth deals.
Yeah, being able to force some appreciation there. Before I forget, I don't know, maybe this is something for another conversation, but we were talking about exiting a deal, and I know we're getting there to the top of the hour, but have you talked with your investors about if they do exit, like, hey, put your money into an opportunity zone, or if you hold it for 10 years and you have no taxes that are due? And so if they were to exit, have you guys looked at opportunity funds to invest in?
We have. So just think about the basic concept, right?
Yeah.
An opportunity zone is the government saying,
depressed.
This area is depressed, so we want you to put some money in it. My business model is I'm investing in stable, growing, boring kind of markets that are doing well, are going to continue to do well, and I'm going to ride that wave along with them. So by definition, an opportunity zone isn't a place I should be putting any money. Now, opportunity zones are done by zip codes, which I think is kind of an interesting way of doing it. And there are markets that are growth markets, but there's a zip code that just carves in where there might actually be a few properties that are technically in an opportunity zone, but they actually are in a good market. That's pretty hard to find. We achieve the same goal from a tax standpoint as far as we're concerned with our 1031 strategy. Yes, if you invest in an opportunity zone, you can get to that point where the taxes are completely forgiven and you don't have to pay. But we think there's just as much value in deferring them, and we've got the ability to defer them much longer than just 10 years. Again, if the fund operated for 30 years, we could end up with $100 million of value in real estate and everybody with a basis of zero. And it's like, oh my God, look how much we're going to have to pay. And it's like, yeah, and look how much we made. It's, if always remember, if you got to write the IRS a big check, you had a pretty good year. There's money in there. So just keep that in mind.
Yeah, I guess that would be more if you're exiting almost. If you guys had to shut it down, that would be hey, everybody throw your money over here, put it in here.
Right.
10 years. Yeah.
Now we haven't made any announcements yet. We will do probably in the next 30 to 60 days. We are going to have a new opportunity coming along, a new investment vehicle that is going to be structured so that people can 1031 on the backside going out. So you won't be able to 1031 going in, but you'll be able to exit via a 1031. And then that puts those folks in a position where I can help them with those dollars. It'll be a little larger investment. It won't be something sized like our fund, and there'll be a few things structured differently about it. But there's a lot of folks that would like to do the work we do on the family office side, but they don't have $5 million. They've got 700,000, but they'd still like to build that perpetual 1031 chain. Yeah. And we think we've got a way to do that.
Yeah, that's great. Staying tuned. And you heard it here first.
Yeah. There you go.
So I want to ask you real fast, and we're getting to the end here, but what would be your best piece of advice, I guess, for real estate professionals looking at alternative assets right now? Either in this economic environment or just for them. I know we were talking a lot of taxes. Real estate professionals get to write off they get to take all the depreciation.
Yep.
So that's a huge thing I talk about quite a bit, but just in general, what kind of advice would you have for people looking to get into alternative assets?
There's two things that we talk about on our podcast and in our other educational material to folks. And a lot of our listeners are not ever going to be investors with us. They own their own portfolios, or that's their goal in life, is to build their own portfolio. And the first thing we say is nobody should be scared by what the current conditions look like. There's always going to be a reason that you'll be able to find to say now's not the right time. And there's just no reason to wait. The sooner you get in, the sooner you can start that process. The second piece of that is don't expect to make any money on that first deal. You will, but the first deal isn't about making money. It's really about getting an education about the process and about how it works. Get a good underwrite put together. It's all about math. Make sure you stay on that focus. It can't be emotional. It can't be, God, I really love that property. That's one of the worst things that can happen. The math has to support the deal. We're very fond of, the focus of you want to constantly be looking for reasons to say no to that particular property. And it's only when you've gotten to the end that, there really isn't any reason to not do this, that the answer then becomes, okay, I should do this. And, if you do that, whether you're starting with, $100,000 and you're buying a duplex down the street from you, or you've got a bunch of folks that are pulling together and you're buying a 40-plex in town, it's all the same. Get in and get started. And a few years from now, you'll know more. You'll be in a better position to do the next deal. And 10 years from now, which I know sounds like a really long time, but it's not, right? I'm sure some of your listeners are, they might be 50 years old. They might be in their 40s. Some of them are in their 30s or even in their 20s. Get started. My gosh, if you're in your 20s, you could spend 10 years getting absolutely nowhere except building a great education for yourself. And suddenly you're a 38-year-old gal that really understands how this all works. And now you've got a 40-year investment horizon in front of you in which you can double once, double twice, double three times, double four times, double. And the amount of wealth you can generate starting that early, that's the one thing that you can't fix, right? If you come to this game, when you're 60 or when you're 50, well, you can't turn the clock back. But in 20 years, you can double your money 3 times, investing very, very conservative.
Yeah, I love that. It's awesome. Very good advice. All right. Well, let me wrap it up. I'm going to ask you a couple questions not related to real estate. What is your favorite pastime not related to real estate?
So my wife and I travel quite a bit. We've got an RV that affords me the opportunity to do two things I really enjoy. One, I love the outdoors and I'm a fisherman. So you will find me on the river during salmon and steelhead season often. That's a lot of fun. I also enjoy astrophotography, so shooting the night sky. We're actually heading out here in a couple of weeks to head back down to Death Valley and Joshua Tree, and we'll spend about a month down there. It's beautiful this time of year in the winter. Not a place you want to be any other time of the year, but we enjoy all that travel.
Awesome. And what's the best thing or memory that's happened to you guys in the last 60 days, 90 days, recent memory?
The best recent memory, gosh, that's a tough one. There's been so many. We've had the opportunity to spend a lot of time with family recently. I took the RV and made a swing and got to see all of my brothers, which is a bit of a challenge, a fairly large family kind of scattered. And, none of us are getting any younger. So, we make it a goal every year to make sure we can get around and see everybody. That was very fun.
Yeah, the RV. I'm talking to the wife. Like, we got to go. Yeah. A buddy of mine has one, and he's basically says I can use it, and I don't take him up on it. But now that my daughter's a little older, I think we're going to start taking it.
It took us a while to get started. My wife and I kick ourselves going, why didn't we do this when the kids were little and at home? This would have been a great thing to do, but we enjoy it now.
Yeah, that's great. And then finally, what's one or two people who've been most instrumental for your success or the way you think?
I would be remiss if I didn't give just an enormous amount of credit to my partner, Bill. He and I worked together as partners for over 20 years. Our business relationship goes back 30 years. Just his impact on my professional life and helping me learn more about how I can take the energy I bring to things, which can be a little strong-headed sometimes, and channel it in really positive ways is really meaningful. And the other, and this sounds really corny, my wife is a very bright lady. She's an artist. If you ever came to our home, you would see it's covered in beautiful artwork. But that's not her technical training. She's got the same degree I have. So she understands this world and is just a great business partner and has been a big part of all the endeavors that we've had.
That's fantastic. Yeah, you're not alone. There's a lot of wives thrown out as the most instrumental, and that's for good reason. You picked a good partner there.
Yeah, absolutely.
Pat, it's a pleasure. It's always good talking to you. I really appreciate you jumping on, sharing your information, your knowledge. Anything else you want to say? Anything I didn't ask you that I should have?
We could talk for days, right? That's the beauty of all this. I certainly appreciate the opportunity. Happy to come back at any point in time. We wish nothing but the best for you and all the ventures that you are having going forward. Anything that we can do to help you. That's the beauty of this industry. It's not really a competitive industry. There is so much work that needs to be done and so many clients that need to be supported. It's really a great place where we can all just help each other.
Yeah, that was one of the first things you told me when we first spoke. I was like, oh yeah, I like this. This is great attitude, great way to look at it. So Wonderful. Again, I appreciate it. I'm going to have your contact information down below, if that's all right with you, in the show notes, so people can reach out to you and find you and just connect directly if they want to. So thanks again. Thanks for joining us on the show today, everybody, and have a good one. Catch you on the next one.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.